Traditional IRAs, Part 3. Can I deduct my contributions? The answer is maybe. Your contributions to a traditional IRA might be fully deductible, partially deductible, or entirely non-deductible. It all depends on a variety of factors, such as your age, total income, your marital status or filing status, and whether you or your spouse are covered by a retirement plan through your employer. Your deduction may also be affected by Social Security benefits you received. You can take a deduction for the total contributions to one or more of your traditional IRAs if neither you nor your spouse was covered for any part of the year by an employer retirement plan. Your contributions are limited to $5,500 a person per year, $6,500 if you're age 50 or older, or 100% of your compensation if less than that maximum. So therefore your deduction is limited by that same amount. On the previous slide I mentioned that if neither you nor your spouse was covered by an employer retirement plan at any time during the year for which your contributions were made to your traditional IRA, that you would be able to deduct those contributions up to the maximum level. The rule is actually rather strict. If either you or your spouse was covered by an employer retirement plan at any time during the year for which contributions were made, you are both considered active participants, and your deduction may be limited. For example, let's say neither one of you participated in an employer retirement plan at work, and you took a new job, and that employer retirement plan kicked in December. Because of that, you would both be considered active participants, and your deduction may be limited. Your deduction is phased out when you have coverage in an employer plan. It's based on your Modified Adjustment Gross Income, or your MAGI. Your MAGI determines your right to claim a full deduction, a limited deduction, or no deduction from your traditional IRA. Your deduction begins to phase out when your income rises above a certain amount, and it's eliminated altogether when it reaches a higher amount. These amounts depend on your filing status. We'll look at some charts later that will break this down for you. Here are some general rules about the deduction phase-out as it's tied to your MAGI. Active plan participants are phased out for single persons with a 2013 MAGI over 59,000. On a joint return, the phase-out threshold is generally around 95,000 for 2013. But it's for a jointly filing spouse who is not a plan participant that the most favorable phase-out occurs, and that begins at 178,000. We'll look at a chart with a little more detail in just a moment. One thing to keep in mind is that the deduction phase-out rules do not apply if you are unmarried and do not have employer plan coverage, or if you are married and neither of you have coverage. That is regardless of your income. An IRA deduction of up to the maximum $5,500 or $6,500 if age 50 or older at the end of the year for 2013 is allowed as long as you have at least that amount of compensation and you have not reached age 70 and a half by the end of the year. Here's a chart that goes into a little more detail about your deduction phase out if you are covered by a plan at work. Notice that your deduction is determined by your filing status and your MAGI. If you're single or head of household and you earn $59,000 or less, you can take a full deduction up to the maximum amount of the contribution that is allowed. If you make between $59,000 and $69,000, you're able to take a partial deduction. And if you're single or head of household and make $69,000 or more, then you are not allowed to deduct your contribution to your traditional IRA. If you're married, filing jointly, or a qualifying widow or widower, and your MAGI is $95,000 or less, then you can take a full deduction. If it's between $95,000 and $115,000, you're allowed a partial deduction. And if your MAGI is $115,000 or more, then you get no deduction. Notice if you're married filing separately, you're really not given a great benefit from this deduction phase out. If you're married filing separately and your MAGI is less than $10,000, you get a partial deduction. And if it's $10,000 or more, you get no deduction. Now we can compare the deduction phase out if you are not covered by a plan at work to the previous chart. If your filing status is single, head of household, or a qualifying widower, and your MAGI is any amount, then you can take a full deduction. If you are married filing jointly or separately with a spouse who is not covered by a plan at work, and your MAGI is any amount, then you can take a full deduction. If you're married filing jointly with a spouse who is covered by a plan at work, and your MAGI is $178,000 or less, you can take a full deduction. If it's between $178,000 but less than $188,000, you can take a partial deduction. And if it's $188,000 or more, you cannot take a deduction. And finally, if you're married filing separately with a spouse who is covered by a plan at work, and your MAGI is less than $10,000, you can take a partial deduction. Or if your MAGI is $10,000 or more, there is no deduction allowed. As we saw from the charts a moment ago, even if you were not an active participant in an employer retirement plan at any time in 2013, your traditional IRA deduction limit for 2013 may be phased out because of your spouse's coverage. We have discussed earlier that if you are married and only one of you is an active participant in an employer plan, you are both considered to be active participants and your deduction may be limited. However, there is an exception to this rule. If you're married and filing separately and you lived apart for all of 2013, then your spouse's plan participation does not affect your IRA deduction. In that situation, if you are not an active participant, then you may claim the full $5,500 deduction limit for 2013, $6,500 if age 50 or older. If you are an active participant, your IRA deduction under the phase-out rules is figured as if you were single. Now that we're all experts on the phase-out rules, let's do a quick recap. The $5,500 deduction limit, or $6,500 if age 50 or older by the end of the year, 2013 in this example, is phased out if MAGI exceeds $59,000 if you are single or head of household. If you are married filing separately, or if you lived apart from your spouse for all of 2013, and you are an active participant during 2013, your deduction limit is phased out if your MAGI exceeds $59,000. If you lived apart for the entire year and you are not an active participant, you qualify for the full deduction. The phase-out rule is not applicable to you even if your spouse was an active participant. If you are married filing jointly and both you and your spouse were active participants during 2013, or you are a qualifying widow or widower and were an active plan participant during 2013, then your deduction limit phases out at $95,000. One last point. If all of your traditional IRA contribution is not deductible, you might want to contribute to a Roth IRA instead. A Roth IRA is a non-deductible IRA that provides for tax-free distributions of the original contribution and distributions of earnings. If some of your traditional IRA contribution is not deductible, consider contributing the deductible portion to a traditional IRA and the remaining non-deductible portion to a Roth IRA. Traditional IRAs, Part 4. Active participation in an employer plan. What is an employer plan? We've already discussed how being in an employer plan from work can limit the deductibility of your contribution to your traditional IRA. There are many types of employer retirement plans, including a qualified pension plan, a profit-sharing plan, or a stock bonus plan. It also includes qualified self-employed KEO plans, simple plans, or SEP plans, a simplified employee pension plan. It would also include a qualified annuity plan. Two other types of employer retirement plans include a tax-sheltered annuity and any plan established for its employees by the United States, by a state or political subdivision, or by any agency or instrumentality of the United States or a state or political subdivision, but not eligible state 457 plans. Under any type of the employer plans that I just mentioned, if you are considered an active participant for any part of the plan year or within the taxable year, you are treated as an active participant for the entire taxable year. You may be treated as an active participant even if you worked for the employer only part of the year. Some employers offer a defined benefit plan which provides a fixed pre-established benefit for employees at retirement. If you are eligible to participate in that plan for the plan year ending or within your taxable year, then you are treated as an active participant. Even if you decline participation in a defined benefit pension plan, or if you fail to make mandatory contributions specified in the plan, as long as you are eligible, you are treated as an active participant. You are also treated as an active participant even if your rights to the benefits are not vested. In other words, if you have only been employed a short time and your rights to the benefits have not vested yet, you are still considered an active participant because you are eligible. A more common type of employer plan these days is a defined contribution plan. A defined contribution plan is a type of retirement plan in which the employer, the employee, or both make contributions on a regular basis. You are generally treated as an active participant in a defined contribution plan if you make elective deferrals to the plan, if your employer contributes to your account, or if forfeitures are allocated to your account. With the defined contribution plan, if any of these events occur in the plan year ending with or within your taxable year, you are treated as an active participant for that taxable year, even if you do not have a vested right to receive benefits from your account. This differs from a defined benefit pension plan, when all you need to be is eligible to be considered an active participant. If you are not allowed to deduct any IRA contributions in 2013 because of the phase-out rule, you may still make non-deductible contributions to a traditional IRA of up to $5,500, $6,500 if age 50 or over at the end of 2013, where you have compensation of at least that much and are not age 70 and a half or older by the end of the year. As we mentioned earlier, another option would be to invest into a Roth IRA. Let's look at a scenario. Alice contributes $5,500 to her traditional IRA during the year. She begins working on her taxes after the first of the new year and realizes she is eligible for only a portion of the deductible amount under the phase-out rule. She can leave the non-deductible portion in a non-deductible IRA, or she can withdraw the non-deductible contribution, or recharacterize the non-deductible contribution as a Roth IRA if she qualifies. You may change the designation of IRA contributions from deductible to non-deductible, or non-deductible to deductible by filing an amended return for that taxable year. If you realize you made an IRA contribution for 2013 and it is not deductible, you may make a tax-free withdrawal of the contribution by the filing date plus extension. This option is available instead of designating the contribution as non-deductible on Form 8606. While your contributions may be withdrawn from your traditional IRA without taxable consequences, the earnings from a withdrawn non-deductible contribution must also be withdrawn, and you must include these earnings as income on your 2013 tax return. If you do make non-deductible contributions to a traditional IRA, you must report these contributions on Form 8606 unless you withdraw the contribution. The value of all of your IRAs as of the end of the year, including amounts based on deductible contribution, must be listed on the form. If both you and your spouse make non-deductible contributions, you must each file a separate Form 8606. There are penalties for not filing Form 8606. If you do not file the form, a $50 penalty may be imposed unless there is reasonable cause. You may also be subject to a $100 penalty if you overstate the amount of the designated non-deductible contribution made for any tax year, unless you can demonstrate that the overstatement was due to a reasonable cause. This penalty applies to each overstatement. This concludes Part 1 of Traditional IRAs. It's time for a few review questions to reinforce what you've learned.